One of the most common questions that investors are asking themselves is how much cash should I keep on hand? The price that people pay for instant liquidity is way, way, way too expensive.
We are investing alongside institutional investors. The difference is we disperse our access and return to the individual investor.
Every economy in the world is facing unprecedented challenges. Every sector of industry is undergoing incredible change. And pretty much every company is adapting its business model. These are times of great risk, but also great opportunity for investors. And for the greatest returns, many look beyond the stock market to the world of alternative investments. Alternative investments used to be a niche sector with very high barriers to entry. What few people realize is that over the last decade, this has all changed. In this three-part series, we're putting a spotlight on those changes and highlighting the new opportunities that have opened up for investors. In part one, we examine the importance of alternative investments within your portfolio. Now in episode 2, we're going to focus on the role of liquidity and short-term cash management. When investors are thinking about portfolio diversification, they also need to think about diversification of duration or time frame. Liquidity can be an important buffer in a crisis and provide a pool of capital for future opportunities along the yield curve. Therefore, cash management is key. Investors should make their capital work for them, even if it's being held for shorter periods of time.
As you probably know today, cash positions are huge in America. We really have this time where people are feeling a little bit uncertain. There's potential tax implications from legislation, and folks need to figure out where they want to put their cash. As we get in a little inflationary period, we do need to offset that with some return that is at or above the inflation rate.
And one of the things I like to talk about is duration and how you think about duration of your investments relative to the liquidity that you might want over time. And I think that the price that people pay for instant liquidity is way, way, way too expensive. So what do I mean by that? I think that people have to focus on making investments periodically, let's say monthly or quarterly, so that you build what I call a rolling portfolio.
That's one of the things that our platform is enabling for our investors. So whether they're looking to make a long-term investment or they're just looking for an alternative cash return that's above market, we have several projects that we have available today that can help earn well above market rates in their cash management. And it can be from a couple of months to 6 months to 12 months.
Different investors have different needs and different levels of risk appetite that will define the level of cash holdings that are appropriate to their outlook. Yieldstreet have a variety of products to ensure the right level of diversification to suit all levels of risk.
So one of the most common questions that investors are asking themselves is how much cash should I keep on hand, right? Something goes wrong, I lose my job, I have an emergency, how much cash should I keep on hand? The biggest problem with cash is they say it burns a hole in your pocket, right? It's not making you money. And so what we focused on at Yieldstreet is trying to create a few products to help people solve for short-term investment needs. So we have short-term note products that start at 3 months, 4 months, or 5 months that enable people to access relatively short duration liquidity. Then there's a next level, which are people that are saying, hey, I need to be somewhere between 6 to 18 months. So that next portion of my portfolio. So for example, we launched a supply chain finance program where you have some offerings that are 6 months, and you have the supply chain finance fund that might be 18 months long. But in both of these cases, what we're trying to strive for is to give you the confidence to invest with a part of the cash that was otherwise sitting in the bank, but also knowing that to the extent you would need it within a relatively short period of time, you'll be able to access that liquidity. And so again, really focused on the thesis of how do I make sure that my money works for me as hard as I do for it.
For many investors, some of these products might sound unfamiliar. Short-term notes, as their name suggests, provide simple and efficient ways for managing short-term cash balances.
So our short-term notes program was created to help people invest their money for a short period of time. So essentially what you do is you make an investment in short-term notes product.
So if somebody has a project they want to do 3 months from now and they want to earn some yield, they could tie their capital up in a short-term note. They get a little longer with some of our supply chain finance products, but all of them are relatively short-term, fairly liquid, and put into a position where we can get some returns on cash as people are trying to think about their longer term investment cycle. And what their longer term strategy is, they can earn money on the platform while they're thinking about it.
Short-term notes are at the plain vanilla end of the cash management spectrum.
Most of the major Fortune 500 companies use supply chain financing to basically enable themselves to get their suppliers paid quicker and to extend their terms of payment that would otherwise happen. So, for example, if I'm Walmart and I want to have my supplier paid today for the goods that they've given me, but I want to extend my terms so I can sell those goods on my floor to cash conversion and then pay my invoice, it gives me the ability to cash manage. So we've been talking about cash management, and that allows businesses in America to cash manage. It's normally handled by banks and finance companies, and the yield is quite low because the credit is quite high quality. There's disruptions and lots of unmet needs in supply chain finance. So we think it's an area that will continue to grow, and it's one of the areas I have my team focused on.
Private business credit is a new product offering from Yieldstreet. It can take the form of loans or leases, helping the expansion plans of a wide range of businesses.
Private business credit is a vertical here at Yieldstreet that was created just about a year ago. My partner, Barbara Anderson, and I joined the company to launch a private business credit vertical. People that aren't qualifying for 3% bank money but have expanding businesses that need access to credit and don't have an opportunity. And often many of these deals that we look at are emerging companies. They may have limited operating history, great exposure, great plans, and great growth. And they can grow either through raising additional equity and diluting themselves, or they can look to someone, to us or one of our originator partners, to look to originate debt for their program. We look at consumer loans and we look at commercial loans. So on the commercial loan side, we do everything from term loans to growing businesses. We provide commercial leasing for equipment, kind of like the equipment in this room. We've actually worked with some movie studios and other folks that have equipment, farms, etc. We look for people that have a great growth story, and now that the world's coming back online and commerce is back in trade, that have a growth plan and they need growth capital. And we like to bring their stories to our platform, so our platform is a two-sided platform.
These cash management products can provide yields over fixed short-term periods, compared with other tradable securities or savings accounts. Investors just have to pick the duration that suits their profile.
Today in our supply chain finance programs, you can go as short as 120 days. So basically what happens is the buyer will come to us and they'll say, I've approved $1 million in invoices to this supplier, and I would like you to pay them, and they've agreed to take a discount on that payment to what I owe them. And so ultimately what we do is we purchase the receivable that the supplier has to the buyer at a discount with the promise to pay directly from the buyer. So in 120 days, not 121 or 122, the actual agreement says on day 120, they're going to pay the full invoice price. And so what that enabled them to do in that 120 days was put the product on the shelf, sell it, convert to cash, and they now have the cash to pay the bill in 120 days. The next thing you can do is we have 180 days, and then we also have a third product, which many of our investors, as they came in and tested out our platform, put their money in, got money back, put it back into the next supply chain finance, and there's supply chain financing opportunities available about every second week, so every other week on the platform. And then many of them asked if we could potentially have an auto roll function where they didn't have to get their money out, put it back in, make a new investment. Was there an option that they could just auto renew back into the same supplier-buyer relationship and let the money kind of roll and compound? We are investing alongside institutional investors. The difference is we disperse our access and return to the individual investor, where the other institutional investors are benefiting at the institutional level. So that's one of the best images I can give you of how we're giving that access to our investors. And if you're in a position to diversify and de-risk and can use the current income focus of our platform, it creates a unique current cash flowing opportunity that complements the other securities in the strategy. This is going to give you something that's going to pay you on a relative basis every month. And many of our loans are bridge loans and term loans that have tenors of less than 24 months, so relatively short term, and something that you can go enjoy your life. That's the other part. So if you're trying to set up to fund a college education or pay the books and tuition of your child, and you want to put X dollars in and let the interest that comes in monthly handle that, you can strategically say, I can enroll in this 3-year program, and over the next 3 years, I know I have this income coming in, and I can use that to pay for this good.
Yieldstreet has created a suite of products that creates flexibility and efficiency in the cash management process. Diversification helps mitigate risks, but the main benefit is that Yieldstreet is giving investors access to the returns that have historically only been available to institutional investors.
The whole purpose of Yieldstreet is to give the common investor direct access to the uncommon access that we're talking about. All of these deals who we're competing with are going to be hedge funds, credit funds, family offices, and the other institutional investors that are out there that are specifically goaled with funding these types of transactions. The difference for us is our ultimate source of capital is individual investors.
A balanced portfolio should have investments with varying degrees of duration. Short-term notes, supply chain finance, and private business credit are some of the products that Yieldstreet provides for easy access and short-term returns. But most investors are really planning for longer-term goals. Yieldstreet has a wide range of products that help investors plan for those needs, including real estate and art finance, which we'll feature in the next episode.